If you've been in the crypto world for any length of time, you've almost certainly heard this term thrown around, paper Bitcoin. And it's a concept that really gets to the absolute heart of what it means to own a digital asset. And, it begs a pretty intense question. Is the Bitcoin you think you own actually real? Or is it just an IOU, a paper claim on an asset that somebody else is holding onto for you? All right, let's get into it. Okay, so what in the world is paper Bitcoin? Well, the simplest way to think about it is this. It's any time you're investing in Bitcoin without actually holding the keys to the asset yourself. The best analogy, and it's a perfect one, comes from the old school markets, paper gold. You see, most gold traders aren't dealing with physical gold bars. No way. They're buying paper contracts, like futures or ETFs that just track gold's price. Paper Bitcoin is the exact same idea, just for our digital world.
So, if all this paper exists, who's the one printing it? Well, it turns out there are 5 main groups of issuers that have really come to dominate this whole landscape.
And this is where it gets really interesting. Just look at the sheer scale of this. We are talking about roughly 32%. That's nearly a third of all Bitcoin in existence being held in one of these paper forms. Exchanges are by far the biggest slice of the pie at 15%. Then you've got ETFs, corporate treasuries, governments, and even a little piece in the world of decentralized finance. Let's break down what each of these really means. First up, crypto exchanges. They're the original and, as we saw, the largest issuers of paper Bitcoin. Now, they offer super easy access, but their history is, well, it's complicated. You have these huge disasters like MT-GOX and more recently FTX that left customers holding nothing but worthless paper balances. They were basically IOUs for Bitcoin that just wasn't there anymore. That whole history is exactly why, after FTX went down, the entire industry made this huge push towards proof of reserves to try and claw back some of that lost trust. Next up, you've got the new giants on the block, Bitcoin ETFs. These are regulated funds from names you know. We're talking BlackRock, Fidelity, and they make it incredibly simple to get exposure right from your normal brokerage account. But, and this is a big but, here's the catch. For an asset built on the promise of transparency, most of these issuers do not publicly share their wallet addresses. So what does that mean? It means the public just has to trust that the Bitcoin backing their shares is actually sitting in a vault somewhere. And right along those same lines, we have treasury companies. MicroStrategy is, of course, the most famous example here. When you buy their stock, you're not buying Bitcoin. You're buying shares in a company whose success is tied to its giant pile of Bitcoin. And, just like the ETFs, they've been very, very reluctant to show the world their wallet addresses. Then there are governments. Yeah, countries like the US, China, and the UK have become massive holders, mostly from seizing it in criminal cases. This is a totally unique kind of paper Bitcoin, right? It's held at the state level with almost zero transparency. It's like a national stockpile that could one day influence policy, but for which we have very little public proof. And finally, you've got the DeFi version, wrapped Bitcoin. The idea here is you create a token on another blockchain, like Ethereum, that's supposedly backed one-for-one by real BTC held by a custodian. Now, it's a bit more transparent. You can usually verify the reserves on-chain, but you're still trusting that custodian. And that promise to swap it back for real BTC, well, that's not always a guarantee. So with nearly a third of all Bitcoin tied up in these paper promises, what kind of impact does that actually have on the market? Well, as we're about to see, it's a massive one. It shaped Bitcoin's biggest price cycles. And this timeline just tells the story so perfectly. Look at 2017. The CME launches Bitcoin futures, and almost to the day, that marks the top of that bull market. Then, fast forward to 2021. You could argue that entire bull run was kicked off by paper Bitcoin when MicroStrategy made its very first purchase back in August 2020. And then, of course, the 2024 bull market was just lit on fire by the launch of the US spot ETFs. I mean, you can't deny that correlation. So here's the key takeaway from all that. For all the controversy, paper Bitcoin has been an unbelievably powerful engine for growth. It made the asset accessible to a much, much wider audience. It attracted huge amounts of capital. And maybe most importantly, it gave Bitcoin the legitimacy it really needed to be taken seriously by the big institutional players. But all that accessibility has come at a cost. It's created this fundamental tension, really a crisis of trust, right at the very heart of the ecosystem. Because at the end of the day, it all just boils down to one simple question, doesn't it? Can we actually trust the institutions that hold all the keys? And while this trust issue exists everywhere, from the exchanges to the ETFs, the loudest criticism has definitely been aimed at MicroStrategy. With this mind-boggling stash of over 700,000 Bitcoin, critics are constantly asking for on-chain proof. The company's refusal, which they say is for security reasons, has only fueled these allegations that maybe they're using derivatives or even reusing their Bitcoin as collateral for other deals, a super risky practice called rehypothecation. Now, Michael Saylor, the company's executive chairman, has pushed back, and pushed back hard. Earlier this year, he just stated it plainly. We buy real Bitcoin. We audit our custodians. We don't rehypothecate. You shouldn't either. It's a very strong denial, but for a lot of people, the questions are still there. And the stakes here could not be higher. As BitMEX co-founder Arthur Hayes put it, the biggest risk to the market isn't a price crash, it's a custodial failure. A major hack where a custodian loses $50 to $100 billion in crypto, that wouldn't just be a disaster. In his words, that would be the end of the cycle. Chilling stuff. So, all of this brings us to the fundamental conflict that's shaping Bitcoin's future. It's this battle between real, self-custodied Bitcoin and this convenient, trust-based world of paper Bitcoin. And these are the trade-offs, right? Paper Bitcoin is undeniably convenient, it's accessible, and it fits perfectly into our regulated financial system. But it comes with that nasty counterparty risk and a real lack of transparency. On the other hand, self-custody. That embodies the entire original idea of Bitcoin. True ownership, resistance to censorship, no one to trust but yourself. But let's be honest, it's still complex, it's intimidating for a lot of people, and it is totally unforgiving if you lose your keys. But what if you could have the best of both worlds? In a really fascinating development, regulators actually approved a way for some ETF shares to be redeemed one-to-one for the actual physical Bitcoin that's backing them. Now that could be a total game changer, blurring the lines between paper and real. And this leaves us with the ultimate question. As Bitcoin keeps marching into the mainstream, it's really facing a crossroads. So which path is going to dominate its future? Will it be the easy road of convenience, or the sovereign path of control?